literally where we are at this moment. Bloomberg's reporting is suggesting, because we've got a Fed update this week, maybe people are starting to think after a couple of days of buying, what's the central bank going to say about the outlook for the economy? How sensitive does it feel to you right now?
So it's been a wild few weeks, John. I mean, where we are now, I don't expect market volatility to subside at all. And I think every day that passes here, the market has less faith that there's going to be any sort of government intervention. I mean, look at what happened last week. Nobody was really holding their breath for a Trump put or even a Powell put. And so the question really is, without those two things, what do you do as investors? And I would say a few things. Number one, make sure you are managing your leverage. Over leveraging portfolios here is going to be super painful. I would also say, look at where the VIX is. The VIX is just slightly higher than the 10-year average. And I think that provides some opportunities to look at hedging strategies, structured notes, as well as option strategies. I don't think this is the time to get uninvested. I think this is more the time to protect capital by looking at these hedging strategies, but also looking to other asset classes, whether it's gold, whether it's alternatives, whether it's fixed income.
And does your thinking shift at all if you see some added selling pressure? Like, I'll just the general terms that people use to describe where we are in a market cycle. We already saw the S&P officially correct, which really just means a 10% decline from its peak. We'd have to see a 20% decline for it to officially be a bear market. So nowhere near that at this point. But there are a lot of stocks that are in bear markets, particularly in technology. If you hear that word more, does that start to trickle into the psyche of investors? Does that shift your thinking? Or no, same thing, just look for pockets of opportunity and maybe reposition?
Absolutely. I mean, John, I was talking to a bunch of clients last week who are sitting on cash, looking at these contrarian signals that are a buy, looking at the market in correction territory. And my advice to them is, we're still a little too early here. We still need to see more weakness. We also are hopeful that we're going to get some policy stability after April 2nd. And so I think it's okay to go a little bit into these names, but don't expect, again, that we're going to be saying goodbye to the volatility. I think for investors that are looking to opportunities within equity markets, even though we do see upside on the S&P towards the end of the year, I think international stocks could be a little bit interesting. And I'll tell you why. Number one, they are more attractive from a valuation perspective. You're looking at PEs. Europe is 15. Emerging markets are 12.5. I also think about it in the context of the global economy. The U.S. is 16% of the global economy, 65 to 70% of global markets. And so that's just telling me that international names are under-owned. And finally, and this is more for U.S. dollar denominated investors, we know the U.S. dollar is overvalued. You and I can argue by how much, whether that's 10, 20, 25%, but at some point we think the U.S. dollar will weaken, which will provide a tailwind to returns. So in the equity markets, I still like internationals. It's still too early for tech for me, and I'm looking again towards some of these other asset classes.
And when you start thinking of globally other places to be invested, because I'm glad you brought up the Europe story, to have general pressure for the S&P, but to see some of the key indices in Europe in positive territory this year is eye-opening. I guess, are you a short-term investor? Are you renting these stocks? Are you looking at the landscape and saying, this seems like enough of a shift, whether it's on the economic front or where valuations were heading into this recent volatility or the geopolitical stuff, that no, we are going to have more exposure to markets like Europe for call it the mid to long term at this point?
Right. So UBS has their capital market assumptions, which we update, once or twice a year. We just saw those last week. And what it showed us is that looking at over the next business cycle, we actually see more upside to European names, to international stocks more broadly than in the US. So our expectation is that European stocks over the next market cycle will be up 9%. I also think on a shorter term basis, there's a stronger probability that you're going to see continued rate cuts in Europe versus in the U.S., and that will continue to buoy European names for the shorter term as well.
Okay, and then obviously the stock market is watching the bond market. We keep hearing about that and all the dialogue on, what is President Trump watching these days. When you look at investing in the world of fixed income right now, what do you see?
So, John, let's take a step back. What is the fixed income market actually telling us? Well, it's pretty dovish if you look specifically at, Fed cut expectations. We're at 80 basis points plus or minus. That's very different to what we saw in January. What I'm telling my clients, though, is that the fixed income markets are not always right. They are not always accurate in their predictions of a slowdown or a recession. We saw that in 22, 23. We saw that in 2019. We saw that in 2016. 2020 was a little bit different. That recession was induced by COVID. And so what I'm saying is that we need to look at the data more closely. We need to focus on the hard data, not the soft data, right? The soft data is showing a lot of weakness. The hard data, less so. Look at yesterday's retail numbers. They weren't great, but frankly, they were still positive. And so in terms of fixed income, we still think no recession. We think that 10-year moves to 4% by the end of the year. And then to answer your questions, in terms of subsectors to get exposed to, I would look at medium duration treasuries and high quality investment grade corporates. I think this is going to be a good place to stay as this volatility continues.
Brenda, good to get you.